Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A very warm welcome to our GFM clients and guests this morning for an update with one of our favourite fund managers, Magellan, who run the hugely successful Magellan Global Fund. We're absolutely thrilled to have Arvid Streeman from Magellan joining us this morning. I'll officially introduce Arvid in a moment, but Arvid is the head of macro at Magellan and a co-portfolio of the global equity strategy. As incredible as it seems, we're already into April of 2021. It only feels like yesterday that it was the end of a very difficult 2020. This is our first webinar for 2021, and as our clients know, during 2020, we ran a hugely successful range of webinars on behalf of our clients in the absence of being able to see our clients face to face. As I said, this is our first for the year, and we'll be running the webinars again during 2021 to keep our clients up to date with investment markets and with the thoughts of some of our favourite managers. In addition to our webinars, we're planning to run our successful face-to-face seminars again in 2021. We're planning our first seminar for May. Invites will go out in late April, so keep an eye out for those. It'll be great to get together with our clients face-to-face in that forum. Fortunately, the start of 2021 has been much better than 2020. Investment markets have been kind and client results for their portfolios have been particularly sound. And on the COVID front, fingers crossed, things are feeling more like normal. It has been great to see clients coming into the office. So without doubt, one of the best known fund managers here in Australia around the world is Magellan. They've almost developed a cult-like following. Since 2007, Magellan have run the hugely successful global share fund. And what's really attracted us to Magellan as a manager and why we put Magellan in our clients' portfolios is that they're focused on investing over the medium to long term, looking to get attractive risk-adjusted returns, while minimising the risk of permanent capital loss. So rather than a focus on the relative benchmark returns, the focus is on medium to long-term returns with minimising the risk of permanent capital loss. We're fortunate enough to see under the bonnet at Magellan. I can absolutely assure our clients and the guests that are dialing in today that the calibre of the team at Magellan, the calibre of the process, and the end portfolio that Magellan end up within their global fund goes through a process of significant rigour. So look, before we get underway today, it's important to disclose that today's webinar is general in nature. We asked everybody in the invite for the webinar if there were any questions, and we received a very large array of questions. Again, it's going to be difficult to get through all of the questions that were asked by our participants in today. We'll do our very best to get through them, but the nature of today's webinar is general. If you have any specific questions in relation to what's discussed today, please feel welcome to call our office to speak to an advisor, and we can give you a more specific update relative to your circumstances and the questions that you have to ask. So allow me to introduce Arvid. Arvid joined Magellan in 2014 as a senior analyst in the financials team. In 2017, Arvid was then appointed the head of macro research and chairs the macro committee. In 2018, he was made a portfolio manager, and in 2020 promoted to being a co-portfolio manager with the global equity strategy. Prior to being at Magellan, Arvid spent 10 years in research departments of Morgan Stanley and UBS. Arvid holds a Bachelor of Economics, first class honours, mind you, and from the Australian University and is a CFA charter holder. Arvid's also a member of the Magellan Investment Committee. So Arvid, a very warm welcome. Good morning.
Well, thanks, Paul, for the kind words, and it's great to be here to tell you and your clients our story and also share our thoughts.
Thanks, Arvid. Let's start. Let's start with the Magellan Global Fund. Look, a lot of our clients have been investors for a number of years and have a real familiarity with the fund. But I wouldn't mind starting with a refresher of the investment objectives of the Magellan Global Fund, which I think are really important to consider.
Yeah, sure thing. So there are two objectives of the fund. The first is to have our, I think it's about to come up on the screen. The first is to have attractive um, returns over the medium to longer term. So we're not targeting returns over, the next month or the next 3 months. I think you alluded to that, but over a longer term, when we have this long-term view, and we're targeting 9% net of fees through that longer-term period. And I think if you look at shorter-term periods, there's a lot of volatility in the market. And it's hard to have conviction in picking some of those things over the shorter term and what's going to really drive markets over the shorter term. You can have higher conviction picking what is going to be a longer term trend in our view. And I think that you should invest where you have conviction. If you're not investing where you have conviction, then I think you're gambling. Okay, so that would be the first thing. That's the first objective. The second objective, and you touched on this, Paul, is to minimize the risk of permanent capital loss. And in reality, that means that when the markets are falling, we aim to fall by less than the market and materially less than the market, mind you. And why that's important is because it's in those periods that you really want to sleep well at night. Okay, and I think people start to get a little bit worried when markets are falling. There's a lot of these bad news bad stories in the press, and we aim to minimize that downside, which can take an emotional toll, of course. So that we'd have those two goals for the portfolio. And I think the thing to stress here is those two goals actually oppose each other in some sense, because if you wanted to maximize your returns over the long term and you were unconstrained, so you didn't have that second goal, you'd probably buy the most speculative things you could buy. Okay, and that's not what we do because we are constrained, and so that constraint actually is binding, and it really does sort out some managers from the others. I think if you take a long-term view and you only look at the first thing, then if the first goal, then in a period of market weakness, you can really get punished. So I think having those two there is really important.
But I'm really curious on this minimizing the risk of permanent capital loss, this downside protection. So, how does Magellan do this? How do they construct a portfolio with their global fund? And what are the various mechanisms that Magellan can use to provide downside protection?
Yeah, look, Paul, I think there's a few things here that are important to understand. The first is in your stock selection. So there's the individual stocks at which we're actually looking at. So the world's a big place. There's a lot of things you can buy, but we narrow that down from 10,000, say, of global equities around the world to around 200 to 300, which we would invest in. And the thing that we're looking for there are companies that are high quality. And what we mean by high quality is companies that can earn more than the average company in a sustainable fashion. Because ultimately, if you think about it, what we're trying to do with that first goal is to grow faster than most other people. The side benefit of looking at quality companies is not only do you get that first goal, hopefully, but the second one, which you're asking about, and it's those quality companies are the ones which can usually, I would say usually, withstand economic downturns, political shocks, whatever you think is concerning you, better than an average company. So I think the quality filtering that we do is really key here. And we've got a team of 30 analysts who don't look at that many stocks. It's interesting, a lot of managers, their analysts would look at sort of 30 to 50 stocks. In our team, our analysts are looking at, on average, 8 stocks. Okay, so they spend a lot of time really digging into the weeds. And when they are speaking about their stocks and introducing their stocks, we often have reports that are 100 pages long, which really go into a lot of detail on all the risks. And that minimizes that downside risk. The second thing I would say is that because of our size, we can engage with CEOs or external high-profile consultants much better than you can if you're a smaller manager. So, for instance, one of our companies we're interested in our portfolio, we rang up the CEO. Now, normally that's not something that you can do, but because we were a major shareholder, companies listen to their major shareholders more than they listen to the minor shareholders. We got on a video call, much like we are having now, very quickly. And I think that's something that's really important, to get that timely information from the horse's mouth. We also have that type of thing with some of our consultants on the macro side. Janet Yellen, who was a consultant of ours up until recently, she found a better job with running the US Treasury. But we've got some ex-Fed people in there as well. But I'd say that's the second thing. The third thing I would say has to do with the way that we pull together all of those stocks that we're looking at, and how we build the portfolio. So for instance, when we're looking at the portfolio, we do two things. The first is that we limit the exposure to the market to 0.8 or 80%. And what that means is, if the market's going up, we typically will cap our exposure to market movements by 0.8. That also works in the downside, okay? So if the market's going down, it falls 10%, then at maximum, we should fall by 0.8. In reality, in history, it's usually less than that. But that would be a portfolio construction goal, and that's what provides that downside protection. I'd say that the other thing that provides that downside protection is that when we look at the overall portfolio, we actually split it into two parts. We would call one part the defensive portfolio, which has defensive type companies. So let's think of things that are consumer staples. So an example would be Woolies. We don't have Woolies in the portfolio, but that's an example of something that shouldn't really fall that much if the market falls. So that would be half the portfolio, and that's more than what you would see in a lot of other portfolios around the place. The other half of the portfolio, it's kind of the opposite. It's the growthier part of the portfolio. So I'd say it's those three things which drive that second goal that's on the slide there.
Thanks, Arvid. Look, as the head of macro research, I'm really keen to pick your brain on probably three major global macro themes at the moment. I really want to talk about COVID. I'm keen to talk about the economic outlook, and I'm keen to talk about politics. So let me start with COVID, if you don't mind. So no doubt there's almost been a euphoric response in investment markets to the rollout of the vaccines that are available for COVID. I guess the question I would beg to ask is the market right in being so confident about the outlook for the vaccine and the effectiveness of the vaccine to COVID?
Yeah, well, Paul, it's interesting because if you go back a year ago when we were all starting to get locked down, remember the debate a year ago was whether we will actually ever get a vaccine, because we'd never had one for AIDS after years of trying. And there was a lot of the sort of bleak press out there that we're going to be locked down forever because you'll never get a vaccine. Luckily, as we all know, and you pointed out, we did get a vaccine. But the question is, has the pendulum swung from all the way to the left to all the way to the right? And here is how we're viewing things. The first thing I would say is that viruses mutate, okay? They always have. That's why you get an annual flu shot instead of a one and done flu shot. So when you're thinking about the current batch of vaccines, then and the possibility of a mutation, there's always going to be a mutation. The risk is that the virus mutates to such an extent that it makes those existing vaccines ineffective. And what I would say here, Paul, is that we would have high level of conviction. I remember I talked in levels of conviction before. We would have a high level of conviction that you are eventually going to get an escape mutation. It's almost inevitable. Where the uncertainty really resides is when that occurs. Is it in 10 years' time? Is it in 3 years' time? Or has it already occurred? Okay, it could already have occurred, by the way. So we would say where markets are at, markets are rallying. It's not entirely due to the vaccine, although I think a large part of it is. I think people are underestimating the potential for we call it an escape mutation, to render the existing vaccines ineffective. And it's a real possibility. Now, if it occurred, I think you've got to, when you think about these things, you've got to think about the probability, and then if it does occur, what happens? Now, if it did occur, I think it's not going to be as bad as it was a year ago, and let me explain why. Now, a year ago, remember, as we just discussed, no one had an opinion with high conviction that a vaccine would actually exist to counter the virus. If a mutation occurs today, then speaking to all of the medical and scientific experts that we do around the world, their central case is that you would be able to create a new vaccine and get it approved within a time frame of 6 to 9 months, which is very different to what you saw a year ago, which was, I have no idea when we're going to be able to solve this. Okay, so I think it's going to be less of an issue, although it would still have profound economic and societal and emotional impacts if there was a mutation. But I think that there would always be a light at the end of the tunnel. The other thing I would say is that if you do get in that scenario, what's going to happen to markets? Obviously, the economies are going to shut down again and we'd have to pause our reopening. But what happens to markets? Now, if you think back to this time last year, I think the reason why, or just over a year now, the reason why markets fell so quickly and so much is because of uncertainty, okay? Because no one knew what was going to happen. Now, as I just described, I think there's more of a light at the tunnel if you were to get this escape mutation now. So I wouldn't expect uncertainty to explode to the same extent as what you saw a year ago. And that means that markets shouldn't fall as much as they did this time last year or 13 months ago. And you could almost make the case, we wouldn't make this case, but you could almost make the case that markets may not fall that much at all.
I guess another reason why the markets have rallied strongly, Arvid, is that the outlook for the global economy appears more positive now. I guess a combination of economies around the world reopening, strong fiscal support, and perhaps corporates performing a little bit better than what was expected. So what's the Magellan House view on the outlook for the global economy?
Yeah, Paul, I think this is a really important question here, and a lot has been written about this and commentated about, of course. So here's our view. So let's do what we did last time and look back in that position that we were, let's call it 15 months ago, and compare to the position that we are now. 15 months ago, the world was in a relatively low growth place. Okay, it wasn't as though the world was really growing that quickly. It was growing enough, but not quickly. And also inflationary pressures were low as well, which meant that interest rates were low. Okay, now if we fast forward to today, or even 3 years ahead of today, you go, well, what's really changed? What has changed is that we've been through the virus, of course, and the governments have borrowed a lot of money in order to stimulate their economies, which you're seeing come through right now. But once we're through the stimulus and the short-term effects, which I'll get to in a moment, I think you're actually in the same place as where you were 15 months ago, right? The only difference is that the world is a more indebted place, okay? Because the governments have borrowed something along the lines of 25% to 40% of GDP to fund the bit in the middle, which I'll get onto. So if you're thinking about the longer term, I think the world really hasn't changed that much other than the increase in debt load, which of course isn't great for prospective growth. The really interesting part is, okay, if we've got where we were and where we're going to in 3 months, what's the path look like in the middle, right? I think this is the debate. And where we would pitch things right now is that obviously governments are pumping loads of money into the economy. The US famously is putting around 25% of GDP into its economy, or at least in the budget measures this year. 25% of GDP is obviously a very large number. So we think that that's clearly going to spur some growth pickup in the short term, and you're starting to see that. And it's also going to spur some heightened inflationary pressures because it's akin to giving everyone an extra $1 million as a housing auction. Guess what? The price of the house goes up $1 million, right? So I think you're going to see a transitory period or a temporary period of strong growth, strong inflation. The question everyone's asking is, does that continue, or do we just go to that low growth, low inflation period, which I've kind of revealed what our house view is what we get back to. And the reason why we think that we get back to that low growth world eventually is because of a few factors. The first is that all of the things which are creating this pickup in economic growth and inflation are temporary. So for instance, the checks that people are getting in America or the support that the government's giving to people in Australia, that's by its very nature temporary. That only exists so long as it has to exist, okay? So long as there's an economic downturn, then people will get a handout from the government. Once things are back to normal, then there's no political imperative to do that. So I think that the money drops that you're seeing from the government are temporary. They're cyclical. I don't think they're going to last much longer. And I don't think that the politicians are going to continuously spend 25% of GDP. It's impossible, by the way. So that would be the first thing. The second thing is when it comes to inflation, and this is the topic du jour almost in global investment markets. Again, I would say a lot of the things that people are saying as to why inflation is going to rise and interest rates are going to rise are temporary. So government spending, unless you think that the government's going to continually spend 25% of GDP, then that has to at least slow down. The second thing is that the weaker US dollar, I think everyone's sort of focused on the US here. In terms of US inflation, the US dollar weakening obviously increases the prices of imports. So let's call it Toyota cars. You need to pay more US dollars to buy a Toyota car from Japan. That increases inflation in the short term because, by the way, the US dollar's actually started rising again. So I think there's a lot of things which are happening right now which are temporary and cyclical. So I think when Chairman Powell of the Federal Reserve says we're looking through the inflation shock, that would be a scenario that we would share. Of course, there's balance of risks probably to the upside at the moment, but our base case would be that the increase in growth that you're seeing and the increase in inflation that you're seeing will be temporary. And that's really important because that means that the Federal Reserve won't tighten. And we can talk about valuations later, but what the Federal Reserve does with interest rates really matters a lot for equity valuations and, in fact, all market valuations. I might talk about our market outlook here as well. I think that's kind of interesting as well. I've talked about our economic outlook. I know you were asked about the economic outlook, but I might talk about the market outlook as well. So when we look out and trying to figure out the way markets are going to go, we'd say that there are two scenarios here, two likely scenarios, and we'd probably put 50-50 probability on each, okay? So 50% one, 50% the other. The first scenario is almost like a Goldilocks scenario where the virus doesn't mutate, the Federal Reserve, the Reserve Bank, the treasuries around the world continue to stimulate their economies, although in a declining fashion, of course, as I mentioned. And that just means that asset prices just continue to have these tailwinds and continue to rise, okay? That would be our first scenario. The second scenario, which again is talked about a lot in the press, is a material decline in equity prices, let's call it 20% plus, and that could be driven by, I would say, one of four things, and hopefully not all four at once. The first one would be, an inflation shock. So I said that inflation, we expect it to be sort of goes up and then down, and the Fed looks through it, no rate hikes. If inflation's stronger than we expect and there are rate hikes, then I think the mindset of international investors is going to change, and that could trigger a downturn. The second thing that could happen is if the virus mutates and it renders all of the existing vaccines ineffective. And I think that depending on how severe that is, that could send the market lower as well. The third thing is, at the moment, when you look at the markets, there are some things which you just can't explain, like Bitcoin at $60,000, right? And you say, well, there's a lot of things which just seem disorderly. And if for some reason people decide to really shy away from those speculative investments, I think that can drag overall market sentiment down and market prices down as well. The last thing, which I guess is a learning over the past 18 months for a lot of people, is a black swan event. So we would say that, or an unexpected event, we would say COVID was off the radars of most people, right? It's unpredictable. There could be another unpredictable thing. So I would say there's a 50-50 chance of the markets continuing to grind higher and a 50% chance of some correction over the next 18 months.
Yeah, thanks, Arvid. Terrific explanation. We had a lot of our clients who are dialing in today that asked the question about inflation. That was a really great explanation. Thank you. If I could shift to the political front now. So, clearly late last year, we had the US election. We had a Democratic victory. We've got a Biden administration. One of the real worries of investment markets going back a while ago was this fractious relationship between the US and China. Do we think the geopolitical environment with a Biden-led administration in the US is likely to be improved going forward?
Yeah, a crucial question, and we have a lot of consultants who we pay to really monitor this risk, because it did actually drive investment markets lower a couple of years ago. I remember when Trump was really increasing his rhetoric towards China. Yeah. So Paul, I'd say a couple of things here. First thing I would say is that the US and China are never going to be close buddies. Okay, so there is a structural competition that's going on, and we would say that it's competition in every thing that you can think of, from economics, trade, politics, military, whatever you think that any two countries can compete on, they're competing on it. So the backdrop here is not of whether the US and China are going to be friends. The question is whether they can manage the relationship, okay? Because you want some guardrails on the relationship so you don't veer too, you don't bowl the gutter ball, so to speak. So that would be the first thing I would say, is that backdrop. The second thing I would say is that coming into this year, after we knew Joe Biden was going to be the president, of course, the president sets the international tone, of course, which I think is what you're getting at here with China. We were very positively disposed to a reduction in this source of risk. Let's call it geopolitical risk or diplomacy risk, okay? And that's because the Trump administration had a very, well, I'd call it untraditional governing style, right? And that sort of didn't go down well in the international diplomacy space. Now, with Joe Biden being almost an internationalist and a senator and maybe a more traditional type of communicator, then I think that is really where you were going to get some improvement in the US-China relationship. It wasn't so much that they were going to agree on stuff. It was more that they were just going to stop squabbling, okay? Because even if you really dislike another country, you still have to speak to them, okay? So that's where we really have a lot of confidence. Now, I would say that over the past 2 weeks or so, some of our consultants and I guess moles in Washington DC and around the world have really started to question whether that's going to occur, and it's really interesting, and it's all driven by US politics. And what I'm getting at here is that in America, it's interesting. If you walk around Washington, there's a real anti-China vibe around the place. Not a racist thing, but a competition thing, I would say. And that's really driving the political imperative to be seen as tough on China. Now, Donald Trump, of course, was tough on China, and Joe Biden is trying to manage this perception in Washington that he's not tough on China because he's not as tough as Donald Trump. So I would say that fundamentally he should be able to communicate better with China. The question is whether he's on the wrong side of the public opinion. And you know, if you pick up the international press recently, you'd see a lot of stories on Taiwan. And the risk that we're seeing at the moment, and the feedback we're getting at the moment is, well, if you've got Joe Biden and the administration trying to prove to people, in particular the Republicans ahead of the 2022 midterms, that they are tough on China and they're getting criticised, the risk is that they overreact, okay? And we know if they overreact on Taiwan by perhaps lending explicit support to that country, then you know, that's one of China's red lines. So, you know, I think fundamentally what I'm trying to say here is that the US-China relationship should be well managed, but there's a few landmines in the way from the political perspective. So I think you really need to watch that Taiwan thing especially carefully.
Excellent. Look, naturally, Arvid, valuations are such an important aspect of investing. Again, another popular question that we had for people who are dialed into today was, you know, how does Magellan view the valuations of markets at the moment, especially considering the exceptionally strong recovery we've had from that drawdown period in March last year?
Yep. Okay, so what you have in front of you is a chart. Let's focus on the left-hand side chart first, which is for the US market, for the US equity market, it's the price earnings ratio, and you can that's how much you're paying for a year's worth of earnings. And this is a traditional valuation measure that a lot of people like to use, and you've probably seen this chart before. So you can see there that current valuations based on that left-hand chart are almost as high as they were in the late 1990s, which of course everyone knows was a really bad bubble. Okay, so valuations, if you look at that left chart, are very high, and you can't take that chart all the way back to 1929. You can create similar charts, and the story from that chart, which isn't shown, of course, is that the current valuations are higher than they were in 1929 just prior to that massive crash. So very high on a, let's call it 100-year view. Okay, now we also know that interest rates are very low, and lower interest rates support higher asset prices. You only have to look at the Australian housing market to sort of know that whenever there's any sort of wobble, the RBA sort of seems to come in and cut rates, and that supports the housing prices. But anyway, what you can do is you can take this valuation measure and say, well, let's strip out that part which is due to lower interest rates. Okay, and so you're adjusting for, the lower US Treasury yields or Australian government bond yields, right? And so I think this is a better indicator of where valuations are, and of course this is the overall market. There are some things which are high and low within this. This is just an average. Now that's that right-hand chart, and you can see that the most recent observation is not as scary as it was on the left, and that's because of low interest rates. What you can also see is that there was a big dip right at the sort of right-hand side. That was the COVID sell-off. There's been a massive rally since then, which means that valuations have increased. If you look at that right-hand part, right at the very end, then you say, well, how high is that relative to history? And we'd say, well, since 2010, it's pretty high, but it's not really that high if you sort of look at the 1990s. What's the right thing to look at? I think probably looking at something like since the 2010s, because the economies change and fiscal and monetary policy changes over time. And so I look at that recent thing, that recent observation, and say, well, I can see the market got pretty cheap in March, right? You can see that. And it looks as though it's relatively high at an aggregate or overall or average level. Now, it was always expected that evaluation would increase as earnings increase because of the economic reopening. Okay, the question is whether there's more in it just than the economic reopening. And the way that I would describe markets now is that even though that line shows you that market valuations have drifted up, right, on average, I would say there are some things that did that and some things which did that. So I would call this a disorderly market. You can't quite see it because this is just an average. I would say this is a disorderly market, and the things which have really gone up most are the things which are the highest risk or most speculative. So for instance, Bitcoin, Tesla, these kinds of things, where people are saying, you know what, I just want to buy something which is risky because I actually feel very confident. Okay, that's part of the vaccine story. It's part because of the Federal Reserve saying they're going to keep interest rates low. And I think that's really led this disorderly market or this bifurcation in markets. So I think that overall markets may be a little bit expensive. Within that, some things very expensive, and some things, if something's very expensive, something's going to be very cheap. Okay, so I think some things are very cheap at the moment as well.
That's interesting. Okay, now I wouldn't mind becoming a little bit more granular, Arvid, if you don't mind, and focus specifically on the global fund. And in fact, what I wouldn't mind doing is focusing on a couple of the newer positions that Magellan have introduced into the portfolio, most namely Intercontinental Exchange and Netflix. So firstly, if you don't mind me starting with Intercontinental Exchange. So for our clients on dialing today, who are they and why did Magellan introduce this into the portfolio?
Yeah, sure thing. So Intercontinental Exchange, it's actually in exchange circles, it's just called ICE, Intercontinental Exchange. Okay, so let's just call it ICE from now on. Yep. So Intercontinental Exchange, there's a few reasons why we bought that, and let me explain or go through those. The first is that when we look at all of these companies, and remember we were talking earlier about how we filter down the universe of companies around the world into the ones which are the most attractive to us from a quality perspective, which means they should make you more money than most other companies. Exchanges are right at the top of our quality curve. And the reason is, and you can think about the Australian Securities Exchange in Australia, which owns the Australian Stock Exchange, of course, and also the old Sydney Futures Exchange, if you can remember back that far. There isn't actually much you can do to avoid using them if you need to transact in shares, okay? And within the exchanges world, we would split between those exchanges which are equities exchanges, much like the ASX, and those exchanges which are derivatives exchanges. So they trade in financial derivatives, which by the way is a massive market globally. So the equities exchanges are, we would say, slightly lower quality than the derivatives exchanges, because the derivatives exchanges, there's only been one example throughout history around the world of a product which trades on a derivatives exchange, and so the exchange gets all the money when they're traded, of course, which has gone somewhere else to another exchange. They are incredibly sticky. So if you own that exchange, you basically don't lose your customers. Okay, so what ICE is obviously a derivatives exchange. It also has an equities exchange. It owns the New York Stock Exchange, the most famous exchange in the world. And so we look at this company and say, you know what, this is incredibly high quality. But the question, I think, is, well, what's changed? So why did you buy it now? As you know, it's always been high quality. So there's a couple of things here. The first is when you're thinking about what actually drives the trading on that exchange has a lot of things on there which should grow faster than average. So you got to think of what's on the exchange. It's a bit like eBay, right? You know, what are people buying and selling, and do I think that's going to increase in trading? The things which Intercontinental Exchange has, we have confidence around the long-term growth path of that. The second thing I would say about Intercontinental Exchange is that if you think about in America, or you probably use an Australian analogy here, when you're buying a house and you've got to talk to your lawyer, you've got to talk to your bank. I did this recently. It's a bit painful. It's a paper-based process. It's manual. It's slow. It's costly. What Intercontinental Exchange is doing is saying, well, ultimately that's a transaction, just like a stock transaction or derivatives transaction. Let's automate it and digitize it. And that really takes a lot of that cost out of the system, and it improves their long-term runway of growth, or for growth, I should say. The last thing I'd say here is the CEO of Intercontinental Exchange, a guy named Jeffrey Sprecher, who's on it. We've got a podcast with him, by the way, if you wanted to listen to that on our podcast. He created this business from almost nothing, essentially. And within the exchange world, a world which I used to have something to do with back in the day, he is almost a Michael Jordan like figure within that. So, management quality, business quality, and then that impetus for a new runway of growth is what really excited us about Intercontinental Exchange.
Netflix is obviously a very well-known name to most, and I see on the slide here that it's been introduced into the portfolio, the rationale being a long-term shift to streaming. I guess I've got a couple of questions, a bit like ICE. Why now? Why add Netflix into the portfolio now? And naturally, the share price has had such a strong run, even in the lead up to when Magellan purchased it for the global fund. So how does Magellan view the valuations of Netflix?
Yeah, sure thing. So let me talk firstly about why we bought it, and then secondly about the valuation. So why we bought it, you can see on the screen there the long-term shift to streaming. Essentially, I think if you look at video consumption, which TV, video consumption's gone through form factor changes. And remember, you used to have an old TV and you used to have to wait until your favorite program came on, right? That was linear TV. Version 1.0. Version 2.0 is with pay TV, where you were still glued to the TV, but you could watch whatever you wanted, whenever you wanted, right? So you actually took the timing, you had control of the timing of when your show was actually delivered. The next iteration, which is streaming, is where not only can you watch whatever you want at whatever time you want, but you can also watch it wherever you want, okay, on the train, or you don't actually have to be in your living room. And so when we're thinking about constructing the portfolio, we like to have those long-term thematics, because I think you can actually bank on those things if you pick the right one to deliver you long-term returns. So that's the structural story behind Netflix. The other thing I would say with Netflix is that whenever you have these long-term growth thematics, they typically come with regulatory risk. So if you think about something like a Facebook, which by the way we have in our portfolio, or any other sort of disruptive company, which is really sort of I guess stealing other people's profits because it's doing a better job, then you typically have some reaction, right? And you see this best in print media with the internet giants, and the print media outlets obviously didn't take too kindly to losing their profit streams. But essentially what happens is you get some regulatory or political pushback. The thing about the shift to streaming is that there's very little regulatory risk, and it's quite rare to find that structural growth thematic without or with very low levels of regulatory risk. Okay, you think about a lot of companies, and you're always thinking about regulatory risk. So here, this is very unique. I think the only regulatory risk you're really going to find here is local content laws, which of course Australia is familiar with, and perhaps maybe some anti-competition thing, but we would argue it's actually quite a competitive market. So why do we buy it now? Well, when we look at Netflix, it's obviously has pole position within this streaming industry. It's got over 200 million subscribers. So that means that it had a critical mass. And the question for us was always, how do you use that critical mass to solidify your competitive position? And what they've done is they've invested in content. So they've got Netflix studios now, which produce their own content. And the reason why that's important is because if you're reliant on someone else's content, then you're reliant on them for your profitability. Okay, so Netflix has used its strong position and the cash flows and the profits it's generating to reinvest in the business, essentially to shore up its long-term position, and that's really interesting to us. The last thing I would say about Netflix, and it's interesting, it's a unique industry, is that people typically buy 2 to 3 different types of TV providers, whether it's 2 pay TV channels or 2 streaming channels, which means that you don't actually have to be number one. You just have to be number 1 or 2, right? And Netflix, we are confident that it's going to be 1 or 2. Okay, it's a very different industry. Most industries, you have to be number 1, whereas here, I guess the bar's a little bit lower.
Arvid, everything you've said to me so far makes tremendous sense, and it's great insight. I think, it's fair to say that since Magellan set up the Global Fund in 2007, right now the fund, on a relative basis, is probably going through its most difficult period when compared to the benchmark. Now, I know we spoke about the investment objectives of Magellan before, and the fact that you're not tied to the performance of or a comparison of the performance relative to markets. But I must say, I genuinely scratch my head for the reasons for the underperformance. I know I look at the Magellan portfolio. I've just put up a slide with the names that Magellan have in their portfolio, and I do scratch my head as to why that underperformance is occurring at the moment. And I guess I want to come back to something that you mentioned before. So sorry for the long-winded nature of the question/statement, but you mentioned that we've got quite a disorderly market at the moment, or maybe you further referred that we seem to be going through a period where there's very high risk taking. You mentioned Bitcoin. I could throw in GameStop recently. I could even maybe perhaps throw in something like Tesla. So I guess where I'm going with this statement/question is, I look at the portfolio. I think it's a wonderful portfolio. I scratch my head. I wonder why it's underperforming. Is it underperforming because Magellan's not getting caught up in this risk taking that's going on in markets?
Yeah, it's an interesting question, and I think when you're thinking about valuations, let's start at the valuations of the market. I think there's a disorderly market. I think most people would kind of agree with that, and I would say that's a high conviction statement. What I don't have conviction in, or a lower level of conviction in, is when exactly that's going to rectify itself. It's a bit like the mutant strain of the virus. I can tell you that it's going to mutate. I just can't tell you when. So you look at this market and you go, yeah, some things look really crazy. And I think we all agree. The question is, when does it actually recur? Oh, sorry, when does it actually reverse? Now, if you're like us and you're managing within that, and you go, well, I am certainly not going to try and follow that market because it's overcooked. I just have to position for this eventual reversal. So I mentioned earlier that some things in the market had gone up, which creates expensive things in broad terms, and some things which have underperformed, which creates cheap things in broad terms. Now, that slide which you showed, which has all of our portfolio companies, they're all doing very well. Okay, so this is the thing, right? It's not they're not underperforming because they're doing badly operationally. It's just the market attribution of value, which I guess is almost the definition of a bubble, of course. So when we look at how we are trying to get ahead of that, we say, well, there's what we would call a very, very high level value in that bit of the market which has been left behind. Let's call that the defensive space. And there's a high level of, let's call it negative value or overvaluation in that top space, which has performed well. So what we've done is we say, well, let's not be so exposed to this stuff which is clearly overvalued, and remain highly exposed to the stuff which is very cheap. Now, I think over a 3-year period, you're going to win and win by more than you normally would have. But as I said, between now and then, I'm not sure when that reversal or that crossover or however you want to call it is actually going to occur. Now, it's interesting, you've got a slide there on how the fund actually performed. And I think this kind of explains how the fund has interacted with the markets. Okay, so before November, so this is up until October, I think that's the second column there, the fund was actually doing very well because the markets were actually in a sort of a normal, I would say a normal behaving fashion, okay? And we were outperforming by, let's call it 6%, you can see on the slide there. Post-vaccine, where I'd say the market's become very disorderly, you can see that we've got we don't measure ourselves relative to the benchmark, but some people do, and that's fine. We've been underperforming the markets. And we would say, a lot of that is due to market rotation as opposed to our strategy being wrong. I think our strategy is being proven over the long term already. It's just that, eventually you come into these periods where things aren't in a straight line, right? And you can look at that and say, well, that's terrible that the markets aren't in a straight line. But you can also look at it and go, well, that's a fantastic buying opportunity, right? That's the other way of looking at it.
Yeah. And in fact, I've brought up another slide here, Arvid, where this very much leans into you talking about the framework of the defensive side of the portfolio and the like. And whilst, again, this is a pretty busy slide, if you don't mind me asking, one of the positions, perhaps, again, being a little bit more granular with the portfolio, perhaps one of the positions that has caused Magellan, in terms of its relative performance, some underperformance is Alibaba and the pulling of the Ant Group IPO. So I'm really fascinated of Magellan's view on Alibaba because we've got that question a bit from clients. And were there any learnings out of that holding exercise? You're still positioned in the stock?
Yeah, sure thing. So just before I answer that, I might just focus everyone's attention on that third column because that really does break down the underperformance and what's driven that. And I think it's really important to understand what's been causing that. So if you look at the that third column, and I guess the first part of it, the 9% contribution, that's because we have a defensive quality bias. And in a market where people are saying, I don't care about defensive, I don't care about quality, I want low quality speculative investments, our investments get left behind. We would argue that's going to be temporary because, as you mentioned, and I think I've made clear, the operational performance of our companies is still fantastic. It's just a valuation thing. So, we're not concerned about that. And, in some sense, maybe, as I mentioned, maybe that's an opportunity as well. The second part of the underperformance, which is probably around, let's call it half of the importance of the first thing I talked about, would be coming from a couple of stock positions, Facebook and Alibaba. And let me talk to you about Alibaba because the Ant Group IPO, when that was cancelled, or I think they call it postponed, but it's a cancellation by the Chinese government, that created a lot of pressure on the Alibaba share price and also Chinese tech platform share prices as well. Let me explain our thinking and learnings behind that and observations. So when if you go back before the Ant IPO episode, we had always thought that Alibaba and Ant and Tencent, which is another big, you can see on the screen, another big Chinese company, would eventually be subject to higher regulatory risk, essentially, because a lot of the stuff in China, it's a relatively undeveloped country, and they're still developing their regulations in the same ways they're still developing their cities and they're still developing their social infrastructure. So it was always going to be the case that they would catch up, so to speak, to Western standards of regulations and governance, more so on the regulation side. So what happened with the Ant IPO was Jack Ma, who of course was the founder of Alibaba, made some comments in a public forum which contradicted what the Chinese Communist Party was aiming to do, and he essentially criticised them. Now, if you only need to know one thing about Chinese politics, it's that you don't publicly criticise the Communist Party. Okay, so he had done this before, which was the crazy thing. He had done this before, and sort of been hauled over the coals and got into a lot of trouble, and he did it again. The fact that he did it again surprised us. We would have thought that if you'd sort of you've been scared by the authorities, you might not do that again. But anyway, he did it. So I think that's what led to a bringing forward of the regulatory actions, which were always in the pipeline. And what that meant was that there was a rebasing of people's expectations of profitability. There was also uncertainty. We talked about uncertainty before and how that dragged the markets down, the overall markets down a year ago. I would say there was uncertainty in the case of Alibaba. So people said, I'm not sure what's going to happen here, so I'm just going to drag the share price down, I'm selling. Now, when we look forward and we go, well, you know what? Clearly, when you get more regulation, that equals lower profits. I don't think there's an example in history of a company being regulated more and becoming more profitable for it, right? It's generally bad for profits. The question is how bad for profits, okay? And when we look at Alibaba, the share price was down, let's call it 30%. Do we think that this thing is going to be 30% less profitable than it was before? And bear in mind here that thing that I mentioned earlier about US-China relationship and how they're competing, Alibaba, Tencent, the big tech companies, they are driving some of the R&D and investment in things like artificial intelligence, quantum computing, stuff that China needs to compete with America. So the argument is, well, they're going to come down on them, but not too much, because they'd be shooting themselves in the foot if they did. And by the way, you can pull the same argument for the US tech titans as well, because they're in a similar position. So I think what's happened with the fine, you would have seen Alibaba was fined sort of 4% of its revenue. It was a record fine. The stock was up 10% after that, because people essentially said, oh, is that all you're going to do? And essentially what I think's happening here is that the Chinese government, there's a backstory to Jack Ma, which I'll get onto in a moment, basically said to Alibaba, you've been doing a lot of naughty things. Can you stop doing those? And by the way, we're going to fine you because, that's kind of what you do. Now, Jack Ma, who of course was the trigger for all of this, our mail is, this didn't make papers, of course, our mail is that he was kind of hauled in front of, the internal Communist Party the standards board, and kind of said, you've been very bad. He said, I didn't mean to be. They said, go to Hainan Island, which is an island off China, and keep a low profile, and we'll figure out what we're going to do with you, but it's going to be bad. So essentially what's happened is they fined Alibaba, which of course hurts his personal wealth. I think he was told to, sort of lay down the, or sort of reduce the level of, TikTok type videos to reduce his social profile. And we'll continue to support Alibaba as a communist party because they're pulling in the same direction. I think that logic still applies. It was always bumpy along the way and uncertain along the way. So we're still very comfortable in our Chinese technology platform companies. And the learning for us out of that, I know you asked about learnings. The learning for us is that, we've instituted some portfolio controls which limit our exposure to these types of companies. And what we're saying here is we're not limiting it to zero. We're just limiting it to less than what it was before, okay? And that's really to control this risk of Jack Ma. Well, I don't know, could he do this a third time? It sounds crazy, but I don't know, maybe he could. We hope he doesn't. Or other tech titans, maybe Pony Ma, who's the CEO of Tencent, from doing something which is counter to what the Chinese Communist Party wants to do. So I would say that we've reduced our level of risk to, let's call it regulatory risk, internal political risk in China, but we still like it. We still like it. We still think it's a powerful and long-term growth thematic.
Arvid, we're nearly out of time, but I've got one last question. You mentioned before, some parts of the market look very expensive, some look okay, and some perhaps are actually good value. And on this slide, I can't help but my eye being drawn to, on the 31st of October, a forecasting of potential returns, and then looking at the last column, the 28th of February, and seeing that the forecast, and forecasting is obviously it's not precise in nature, but a higher potential return. So is what you're suggesting, or is what this slide intimating, that Magellan now view their portfolio of holdings as being more attractive on a total return basis than back in October?
Yeah, Paul, I think that's exactly right. I know it is a busy slide, but essentially we've got an army of analysts who come up with these numbers and due diligence the numbers and all that sort of stuff, but we're really giving you the punchline here. But essentially, you can see that our portfolio is expected to return more than it did in October, and that's the flip side of underperforming. Okay, if your companies are performing well, but people don't want to bid up their share price, then essentially you just buy those things cheaper and you expect a higher return. The interesting thing here is that two things. The first is that in that bottom right corner, TSR is total shareholder return. It's kind of how much we expect our portfolio to return. Remember that we're expecting, or our goal on the very first slide was to return at least 9% after fees. Let's call that 10% pre-fees. So you can see that we're pretty confident that we're going to hit that first objective. Okay, and I'd say that we're even more confident than we used to be because of what's happened in the disorderly markets. In terms of, I think people always like to drill down into sectors and companies and things, but in terms of, what part of the market is most attractive to us, I would cast everyone's eyes to the first row, which is the defensive part of the portfolio. You can see there's things like Crown Castle and Eversource there. So back in October, we thought that that part of the portfolio, it's around 50% of our portfolio, would return around 10%, okay, over the next 3 years per annum. Now, in that part of the portfolio, because it's defensives, you wouldn't expect defensives to really be the edgier part of the portfolio, so you expect that to be the more moderate part of the portfolio for returns. On average, we expect that part of the portfolio to return 8%. Back in October, it was higher than that at 10%. And right now, you can see that it's even higher again, at 13%. Now, a 13% return from defensive equities, okay, that sounds pretty good to us. And that's consistent with the disorderly market, which I was talking about earlier. It seems as though the returns from safer companies are just as attractive as the returns from high quality, but not less safe, but slightly riskier companies. So, I don't know what everyone else thinks, but if I see a safer option earning just as much, then I think that's kind of a good thing. Oh, yeah.
Arvid, couldn't agree more, and I think that's absolutely fascinating. Look, we're out of time now. So on behalf of the GFM Wealth clients and guests who have listened into today's webinar, a very gracious thank you for your insights. As I said, I found them absolutely fascinating. I could talk to you all day, but we are out of time. So thanks for your time, and I look forward to catching up with you soon, Arvid.
Well, thanks, Paul. It's been a pleasure.